Hi, everyone, and welcome to the TimingResearch.com Analyze Your Trade episode for March 29th, 2022. We are recording this at 4 p.m. Eastern Time, and this is episode number 191. My name is David Kosmeter. I'm the creator of Timing Research, and today we will be discussing your trade ideas. Also, I had someone scheduled for today, but they had some computer issues last minute and had to cancel, so the option professor is here to do a special episode, just with him talking about trades and his other market outlook ideas. So you should be seeing his screen right now, and I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David, and welcome everybody. Good to have you here. We had a very big day in the market, as you all know, a big stampede into stocks today. And sometimes people look for a turnaround Tuesday, but the only turnaround was a melt up to the upside. We're going to talk about what's going on now and basically some of the things I've been talking about in my weekly updates and something I sent out on an alert in the oil market earlier today. And I've been discussing it for a while. Quick background on myself. I've been in the investment industry here for decades, and I've done hundreds and hundreds of seminars on the uses and risks of options, but I'm very familiar with all types of investments, and I obviously work with my own money as well in a wide variety of investments. So I'm going to give you my insight, knowledge, and experience. Again, it's going to be my opinion on the things. We're not giving out advice to anybody. Obviously, we don't know everybody, what their circumstances are. So what we'll be giving you is information, but not advice. Okay, let's get right into it here, because this is a very exciting time, and I'll outline what's been going on here. With regards to the S&P, it's really just jamming through the roof here. Brand new highs above the February high at 46.27. You can see that right on your screen, continuing to trade. Today's high so far has been about 46. Let's see, 40. Again, about 46.30 or so, but obviously just a big melt up. We'll start out on the 20-year graph, and I'm going to move in just so you get a big picture of what's going on in the market. The market obviously was way up here at 4,800, and that was in January. And then we've got a nice big sell-off through the 1 year. The 12 SMA brought us all the way down into here, about 4,100. Okay, so that was about a 700-point drop. Now we've come back up over 500 points. That's even more than the Fibonacci 61.8%. So if this stuff can hold up here, it's way stronger than people thought. And basically it's come down to a few different things, because this thing took off. I'm going to show you exactly where it took off from, because we use these graphs obviously to get in and out of things. Basically, we got a buy signal on our monthly at 42.50. And look how quick it went from 42.50 on that buy signal, and you just ride it all the way up and you're still in there. So the bottom line is that's a great buy signal, and that's a great ride. Now, why the heck would it go from the 16th of March, not even till the end of the month, and just explode to the upside? Well, let's use our common sense. We had a Fed meeting right around this time, right? And what did the Fed do? They absolutely made a comedy of what they think they're doing, which is trying to control growth and inflation by hiking interest rates by 0.25%. Now you've got a 10-year note that's already at 2.5. You got a 2-year note way over 2 and a 5-year note way over 2.5, inverting with the 10-year. So in the public markets, we've already discounted about 10 quarter-point hikes from the Fed, and they're going at 1/4. So right now the market could care less what the Fed does. Do you know why? Because they've already seen that they can handle 2.5% on the 10-year without any trouble. And the reason they can do that is that everyone's got a job, and there's 1.2 million people who could still get jobs, because that was the jobs availability that came out today. So on the labor front, we have a red hot labor market. Everyone's working, everyone's making money. In fact, their wages have been increased. Not as much as inflation, but they've been increased. Okay, so that's door number one. The Fed is so far behind the curve, it's a joke. And it looks like free money is all over the place. So everyone who's sold off tech, right, because they thought these rates are going up and they're going to choke off the high multiple stocks and all that, all those people are covered, and all the people on the sideline are starting to come in, and you've got short covering, and you've got bargain hunting, and you've got people that are underinvested, and they're all coming into a no seller environment. Why would there be a no seller environment? Because look at the chart. It's up, 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 up. And all the different resistance points, let me show you some of those. We had some resistance here in the 4,400 area. That broke. We had some resistance at 4,510. That broke. So all of that resistance now is support if it starts to come down. Now, the key here is it going to be able to hold its water? And that's going to be the key looking forward, because again, this end of the month window dressing, you realize if you're a money manager and you've been out of the market, and in what, 1 day, 2 days, the month is over, and you're going to go into your boss and say you're sitting on cash in this kind of a market, like in the last month. You're going to tell them you're sitting it all in cash? Of course not. You have to go in and buy some stocks to show window dressing. That's what they mean by window dressing. That's all happening right now, and it's been going on for the last 2 weeks. And that's where the panic comes from. You got a tremendous amount of cash on the sideline in money managers. I think I was just reading a report on Bloomberg that's 5.9% cash. That's as high as it was during the 2020 crash. That's as high as it was during the 2008 crash. It's as high as it was in 2000 and 2000 even. I think in 2000 even, it might have gone up to 8%. But overall, it's about as high as it gets. And that's a lot of people that come back into the market because they can't tell their boss they're sitting on cash while the markets are going nuts. And of course, if they're sitting in bonds, they're getting whacked. So what else can they do? They obviously have to get some exposure to stock. And again, when they get into exposure to stock and they go into what? Microsoft, Amazon, Google, the main guys, that's what these indexes are priced on. So obviously the indexes are going to go through the roof when they get into the Apples and the Microsofts and the NVIDIAs and the Googles, et cetera, Amazons, et cetera. And of course, Tesla, big part of these indexes. And they announced some kind of an idea that they might be splitting. So that made people go nuts in that stock. 50% up in like 2 weeks. So the bottom line is that there's a stampede, and if you're making markets down there, you are not stepping in front of this. So you've got a tremendous amount of order imbalance going on. And also your put to call ratio, which a few weeks ago was above 1, is now down towards 0.6, which is around the same level that we were at the high points in January. So there are some cautionary things going on in the near future, and that would be that A, the window dressing is going to be done in 48 hours if it's not done already. B, you have got a situation where the put to call ratio is now way down towards the area where it was when the market hit its peak in January. So we don't have that oversold deal on the put call ratio. But again, you're going to be going through a period before the Fed meeting in the next 2 weeks, and the CPI number, which comes out April 12th, where people may want to take some of this stuff off the table. So you got to be a little bit careful up here as far as an entry level, okay? As far as just entering now, that might be a little bit of a rough racket. You want to be a little careful about entering at this kind of a apex of the move. Not that it is the apex, but for what we know, it is obviously the highest point it's been at in a while. So again, good reasons why it's going up. These earnings are probably going to be very good because operating leverage is still quite good at the companies. And of course, spending is very good by the consumer. And again, the expectations on earnings were dropped way down. So getting over a low bar is not difficult either. So there's a reason why it's gone up like this. The question is it a buy the rumor, sell the fact type deal? And is the Fed, which is really going at a ridiculous rate compared to the inflation rate and the economic growth? I mean, people are talking about stagflation. I've been talking about boomflation. And that's where you have a booming economy and inflation. Nobody's talking about that. I've been talking about it particularly recently because, again, this economy does not look like it's rolling over. And the travel stocks, which I'll get into a little bit during my segment, will give you a little bit of a hint. But again, you can see right there why you should have been long the entire time as far as the technical picture on the monthly. And if you want to know what the reason was and who's the shot that was heard around the world, it was Powell saying, we're going to be careful. We're going to be very careful with raising rates. We're going to go slow. Hey, you know, people are out there spending, people are out there buying, real estate's going nuts still, and this guy's going slow. Well, that's like, you know, there's no cops on the highway. How fast would people drive? Right. So that's basically what's gone on. It happened right after he went up and he said, we're going to go slow and methodical, but we could go fast, but we're planning on going very slow and methodical. And believe me, slow and methodical was really just the green light for everyone to figure, you know, let's cover our shorts. Let's get that sideline cash moving. And now we're at the end of the quarter. Let's paint that tape to make it look like we've been in the market the whole time, make our portfolios look pretty. But again, that thing may only have 48 hours left on it. So you got to be careful up in this region. I don't know where this region will end, but whenever it does, again, you do have a distance between here. And this is on a monthly graph. You've got 130 points just on a monthly graph between the 36 SMA and where we're trading. Okay. If you want to look at the yearly graph, just to get an idea, you know, that's getting fairly far away. You're 230 points away from some of these averages, you know, so this thing has gotten ahead of itself. And again, that's why you got to be careful with new money, putting it into a situation that has had this kind of a parabolic move. And again, you know, is a 0.5% on the table? I would imagine it's definitely on the table from the Fed. Could it a 1%? Come on, we're already at 2.5 on the 10-year, over 2.5, I guess, or around there on the 5-year, and way over 2% on the 2-year, and they're at a 1/4 point. So going 1%, would that be off the table? Shouldn't be off the table. That's how far behind the curve they are. Okay, so we'll have to see. But right now, you don't fight the tape and you don't fight the Fed. And the Fed's saying we're going very slow, so they're not fighting that. And they're certainly not fighting a tape that goes higher every single day. I mean, just to put it in perspective, Apple had the biggest move in the last week or so in the last 20 years. That's a pretty big statement. Okay. All right, guys. So that's basically it. Good market, great market, real good reasons for it to go. And again, it's an across the board deal. You know, whether you're looking at the ARC type stocks, whether you're looking at semis, whether you're looking at the banks, whether you're looking at anything, they all seem to be getting a bit. Okay. Now let's take a look at some of your stocks, and then I'll get into some of the things that I'm looking at as well. Okay. So the first one is VCEL. That's Vcel Corp. Again, some of these I'm not trading, but obviously they look great technically. Let's go back on a long-term basis and see what it looks like. I don't know how long this thing's been around, but we'll find out right now. Okay, so obviously it's at a, you know, they have a story behind them. Anything that goes from 700 and then goes way down here, there's a story. I don't know the story. Let's take a look at a 5-year. 5-year looks like it's still in a downtrend. And so I'd be careful until it got above these kind of prices, which is what, around 43 bucks. So there could be some resistance at 43 bucks. And let's take a look at the RSI real quick and see what that's telling us. Okay, draw the chart. And the RSI is getting towards going through 50. So if it gets through 50 and we blow through 43, you know, this thing could, obviously it has a lot of throwback potential. On the 1-year graph, has it already turned? Yeah. So where are the support levels on this thing? Support comes in 35, 37, right? 35, 37. So as long as it stays above there, you'll be good. RSI is above 50 at 60. Sometimes when RSI gets through 60, it accelerates to the upside. That's what this thing's doing. So they could keep going. Again, I'm not familiar. I'm just talking about the technicals. And then on a 1-month graph, let's see what it looks like. It's obviously gone on. You got your buy signal on the monthly at 34 bucks. So again, there's plenty of potential on this thing. 43 could be a neighborhood where it has some trouble. There's 44, right? 43, 44 could be some trouble, but it is picking up momentum, and that's not a bad thing. So this thing looks bullish as far as I can see. All right, next guy up is DVAX. You know, you try to get lines in the sand, meaning it looks good or it looks bad. If it does this, I would, you know, start reassessing, and that's basically what I'm going to give you here. All right, this stuff here, again, let's go back 5 years and see what it looks like. Okay, it has an ascending blue line. So if this thing gets back above 14, that would be real positive because it is an ascending blue, meaning a 36 SMA, and that's not bad. Your RSI is right here. So if this thing ever gets back above here, you can build a case that it's really going to go after that high point. And so basically keep an eye on that number there. That number there is 1429. Okay, and then if you look at the shorter term 1 year, let's see what it looks like. Yeah, again, getting above 12 and getting above 14. Those are your two magic numbers if you want to see this thing go and fill this gap maybe between 18 and 19. So 12 and 14, two big numbers for this thing to get above. Right now it's testing it. And the RSI here is getting above 50. So right now your RSI is at 49. That's why, to be honest, if it breaks 50, excuse me, 12, it might be a better buy than it is at 1137. The reasoning is that if it breaks 12, that means it would be breaking resistance. Your RSI would be getting back above 50. And so you'd have a pretty good momentum. And this 12 SMA, which is down at 1114, will start rising even further. So does this look constructive? It looks pretty constructive, but the jury's out until we break 12 and until this 12 SMA, which is at 1214, starts getting going. So as long as this stays above 11, 15, 11, 11, 14, that's okay. But to really bring out the party hats on this thing, breaking 12 and 14 would be better ones. Okay. All right. So that's how I see it on Dynavax. All right. Mara. Okay. There's going to be a couple of oils here, and that'll segue into what I just sent an alert out on. And let's take a look at that. Okay. Now, again, this is a market that has a lot of long-term potential. Okay. This is Marathon Digital Holdings. Okay. This is not Marathon Petroleum. Okay. Different. Okay. So anyway, you've got digital holdings here. What does it look like on a 5-year basis? Let's see. Okay. So you look like you got not a lot of lows, a lot of support at $20. So you know where the support is. You're starting to turn the 12 SMA up. If you notice, if it's going to go on a big run, it generally is accompanied by the red line rising, right? You see how it's on this big run from here to way up there. Where was the red line? It was rising. So it's not really rising now, and that would make me a little bit concerned. But it comes in at 25. So as long as it stays above 25, this thing will start, because these are moving averages, they will start turning up. So let's stay above 25 would be door number 1 for me. That would be my defending area. And then as far as the 1 year, let's see. Now the 1 year looks much better because your RSI is broken above 50. You're a little bit extended here. Again, 25 is a big number. You got to stay above 25, and the longer it does, these averages will start moving higher and higher and higher. So again, does not look bad. It certainly would be a hold at the bare minimum. And then basically, let's take a look at it on a 1-month basis. And on a short, if you want to keep it on a real short leash, you want it to stay above 29.30. So 29.30 is your short leash on this thing. Your long leash is $25. And if it really got moving, what's the difference between 85 and 20? And what type of a 50% or 38%, 50%, or 61.8% retracement could there be? That's how you could probably give yourself some kind of target if this thing really got going. The charts are mixed, but they're mixed on everything because they whacked the market so hard that they brought everything down. So again, there was technical damage on everything, but as you can see from the S&P, technical damage has just turned into a very big bull run. So sometimes the technicals will follow the fundamentals. And, the technicals were very bad going into that Fed meeting, but once he spoke, the fundamentals of cheap money, which everyone obviously made a decision is going to stay for a while, relatively cheap money, right? And basically, if the Marathon Digital comes out with good earnings after this quarter, that could be something that could help this. But holding above 25, very key. Getting above 35 would be very, very nice. And let's see if there's any other resistance I can see on the 1 year. Yeah, pretty much like I say, if it can get above the 33, 35, it looks like it would be able to go. Maybe to be doing some more work down here before. Definitely looks like a hold though, as long as you stay above $25. Okay, next one up is this is an oil one. Okay, ConocoPhillips has had a huge run. Okay, and this was what I talked to people about in the alert today. Okay, what you can see here is a bit of, I talked about a little bit of a divergence. We could be seeing one because you see the RSI here was around 73 when it made that high. And then we just made a new high and the RSI peaked out at 71. So you're not making new highs on the RSI. It's not a huge divergence, but it certainly is a small one. Now you've got obviously a very distinct line here on the 1 year that comes in a little bit above 95. So this could just be a pullback to the mean, and holding that 95 neighborhood is very important for this. Looking at a 5-year chart, again, very extended versus the moving averages. So that's why reverting back to the mean is something that could be happening. And the RSI here has rolled over. Okay. All right. So here, let me give you an example. Again, oil's pulling back. I mean, that's what's happening. And again, after no supply on things like grain and oil and everything else comes supply, because the world is round. Again, nothing lasts forever. Market was going up very high up to 4,800, and it rolled over. It went down to 4,100. Now it's back up. Things change. The world is round. So on oil, the whole planet is looking for a big oil. So let's just look at the price of oil and give you an idea here, because I think many of you either are or considering the energy sector. So I think it's important that we cover this, and I'll give you my opinion, my view. Okay, I'm going to try to go out on the 20 years so you get an idea. Okay, this gives you an idea of what's going on. Okay, can you see that we hit a high point here in 08 of about 140, about 147, I think. Let's see. 147, right? Yeah. So that's your high from 08. Now we just had a parabolic move up here to 130, right? Then we're going to go to a shorter term graph so you can see that it had a big drop from 130 all the way down to 90 something, right? Then it had a throwback rally up, right? And it did not take out the 130. And now it's back down here at 102, 104, right? So the idea might be that the oil market may take a bit of a break. And if it does, and if that was a parabolic blow off, which we don't know, for all we know, there's going to be a continued war. Nothing's been settled. But if that is the high point, we're going to go back to COP, and I'll give you a couple of examples of hedging. Okay, we're going to go back. COP. Now, again, it's still a constructive market. Again, it's just very overbought and it's having pullback. That's all you can say. But you don't know where the pullback would go to, because, again, that's pretty extensively overbought. But here's the deal. If you bought it at 35 bucks and it's now at 105, and we're now looking at a price that is pretty darn high, up in this 100 area, is this an area to consider some hedging strategies? And I think the answer might be yes, because you're trying to protect the gain from 35 bucks all the way up to 110, which is what, 65 bucks, 75 bucks of gain. So again, you can use call options. You can use combinations of calls and puts, and you can use replacement trades. And this is an area where someone who has a big gain might consider which one of those type of hedging tactics might make the most sense. Now, because we've got a lot of stocks here, I can't get into the details of it, but at the end of the broadcast, I'll explain how you can get some information on that. But again, this is the neighborhood where the concept of hedging would be something to investigate. Okay. But again, as far as the stock is concerned, the worst thing you can say about it is it's very overbought. And on a 1 month basis, it might have made a little bit of a turn. When it went under 105, that was your indication of a turn. But again, you can see the blue line still rising. So if this thing starts trading back above 103, 104, then it could be right back on the bicycle. But is this a breakaway, runaway, and do we have an exhaustion gap first coming? Is there a fill of this gap coming? It's all possible. So again, but knowing how the hedging strategies work is this is a classic place where a guy who's been in there for a while might want to take some steps to protect that money. Okay, so that's the story on ConocoPhillips. Very strong, pulling back towards some of the moving averages. Still has an undercurrent of strength, but again, it is very extended. And if oil were to break this 90 area and go down towards 80, I would imagine this ConocoPhillips would give up, 10, 15, or 20% off of the current price. All right. Next one up is CUE. Okay, CUE's biopharma. A lot of people are talking about getting back into biotech, and let's see if this makes any sense. It's only a $5 stock, so really, when things are going for $5, my opinion is you're buying an option. What does that mean? Because you're putting up $5, which is kind of like a price of an option. Only this thing will be good until the company goes out of business, which means it could last for a long time. But the risk is $5. So from that standpoint, it's not so bad. Again, you got to be, and again, with these type of things, although they've been in business for a long time, let's see, not 20 years, but going back 5 years, they've been in there 5 years. And obviously they're very volatile, as biotech will be. Some of the trials go good. Some of the trials don't do good. Rumors are this, rumors are that. That's why these things are live by the sword, die by the sword. But if you were going to take a shot at something, you are at the lowest price area. And again, you are in single digits, $5. And again, obviously it's a speculative issue, or else it wouldn't be this volatile. Now let's talk about the 1 year. Now this has a good, what they call a 1, 2, 3 formation here that's being set up, which is exciting. The 1 move takes you up to 6. The 2 move brings you down, but doesn't take out the 4. And the 3rd one is very powerful. And that's one that if it blows through 6, it could get going really well. And you can see it's all coming together here on the moving averages. So this is still a little bit premature. But obviously you get in cheaper when you're premature if you're correct. But right now you're looking at the 2 moving averages of 508, 522, and then you got the blue at 569. So you see what I'm saying? If you blow through 6, your RSI right now, which is still at the lower area, I think it's still weak. It's a little bit weak. It's only at 40. So the bottom line is if we can get this thing through 6 and your RSI goes through 50, and this red 12 SMA starts trending up, that's when you might be able to get a thing here. So I personally would think above 6 would be a better buy than it is right now, because then it would open up the door to all those other numbers. And if you notice, when the red line is rising, like it was between $12 and then $19, or it was rising here between $10 and $15, so, sometimes being a little bit patient, it wouldn't kill you, because people thought it might have been going up here and it went right back into the soup. People thought it was going up here and it went right back into the soup. So again, personally, I'd like to see the RSI above 50. I'd like to see the red line rising. And then since there's so much real estate here, unless it's going to be a deal where it just goes 10 overnight and you can't do anything about it. But again, if you are buying it down here, you're a little premature. And if in fact you're premature and you're correct, you're going to make more money. And again, the $5 puts a floor under it because it can't go lower than 0. So there you go. And again, it is in something where people are starting to, dust off their buy tickets and starting to look at it. IBB is starting to come off the mat a little bit. So I don't know anything about this particular company, but it would be something to keep an eye on, because again, it is way down. And it is showing some formations of a possible turn. All right, next one up is Palintar. Used to be a real favorite of everybody, and then they threw it out with the baby in the bathwater. So let's see what it looks like today. These guys supposedly had all these government contracts. They were going to be lovely. That's when it was trading between here. You see how it's nice, uptrending, comes down, gives you another shot, nowhere near the highs. And then once it blew out 23, that was sayonara. So there's your chart formation. You make a high, you come down. When you go back up, if you fail to take that out, and then you take out this spot here, that's when you got to be careful, particularly when the red line's pointing straight down, right? So pretty much an easy ride to the downside. Now it has turned up. Buy signal really came in at about 11, 12 bucks. So it's looking good. And where's your RSI right now? RSI is at 62. So that's perking up quite a bit. What does it look like in a 5-year? I don't even think it's been around that long. Yeah, it's a recent stock. So again, you know, it's made its turn. The red line's going up. I certainly would not like it to be under 12 bucks. In fact, I wouldn't like it under 12.60. So there's your lines in the sand, 12 bucks and 12.60. And, you know, as long as it holds above there, again, looks like there's a way for it to come back quite a bit. There is a gap down here at 23 bucks. Maybe under certain circumstances, it could get running. But again, look for a pullback and then look to see if it'll hold and then go from there. On the monthly, let's take a look on the monthly. Yeah, so it's extended on the monthly a little bit. But again, you know, we said 12, 13. So there's a line right there coming in at 13. So 12, 13 are your lines in the sand. And right now it is trying to make a turn. Next guy up is MCK. Okay, McKesson obviously has been a great company, and it had a big drop, I'm sure. No, not much at all. Look, this thing is just an animal, just keeps going and going and going. So again, buying it against the support seems to have been the way to go. We haven't even had a pullback on it. Okay, so this thing has been immune to the pullback, it looks like. Yeah, I mean, this thing didn't pull back at all in the last, it's been going up actually. Okay, since the January peak in the stock market. This thing's gone from 250 to 307. So what a great place to be during the correction. It looks very strong. The market moving averages are great. If anything, it's a little on the overbought side from the, you know, the RSI is pretty darn high up here. So can you badmouth it? No. Can you say it might be a tougher area to initiate? Well, you know, there's your, on your long-term graph, there's your price, and here are your moving averages. So it's pretty far away from the mean. And then if you go to the 5-year, again, I mean, obviously it's a great company, so nobody's going to badmouth it. But is it technically overbought? Well, you look at it and make your own choice. The RSI is at 82. So would I step in here now to initiate a position? If anything, you'd probably do limited risk option spreads so that at least if you're wrong, you'd have a limited risk. That's under the replacement trade concept that I'll talk about at the end of the broadcast. But, you know, this is a great company, strong as heck. So, but it is extended technically. It's the only thing negative you could say about it. And on a 1-month basis, has it shown any? Yeah, it's a, you know, very strong. That's all you can say. If you own it, again, you know, if you think it is hitting some kind of a high point, this is another one where some hedging tactics might not be the worst thing in the world, where you use calls and puts or replacements in order to reduce your risk with either all or part of a position. That if the thing does have a quick drop for whatever reason, you've done something to protect your equity, but you have the ability to continue to make some more money because the strategy allows for that. Next guy up is Wish. I never heard this one yet, I don't think. Let's see, wishful thinking here. Context logic. Oh, this is a cheapie. So obviously it's a speculative under $5 deal. Hasn't been around that long. It's been around 5 years. Nope. Has it around 1 year? It has been around at least 1 year. Okay. So I'm not familiar with the company. All I can tell you is whatever it did, it came out here and it's been on a down draft ever since. But obviously people are looking at it now because it is making a bit of a turn. So where are your moving averages? Looks like 220, 214, 219. Where are we trading? 254. So where do you want to stay above? Stay above $2, okay? As long as it stays above $2, these averages will start rising. And the more they rise, the better off you are. So again, not sure what these guys do. I'm not familiar with them. Technically, it does look like it's trying to make a turn. Your RSI is at 60, so it's above 50. That's not bad. It's above its moving averages. That's not bad. And let's go to the 1 month. Yeah, you got a pretty good buy signal down here as soon as the red line turns up, and that came in at about 180. And then right now, if it got under 240, that might start turning the red line down. So 240 would definitely be a warning shot. Under 230, a second warning shot. And then, of course, if you blew $2 out, then you're back in the soup. So again, a speculative issue just by looking at it, but something that, like any option, it can't go lower than zero, but it has a lot of potential if it got moving. Again, not familiar with the company, but that's the way the numbers look to me technically. All right, UNG. Natural gas. I'll tell you another natural gas one that I've been looking at. So here you go. Let's go out. How long has this guy been around? Go the 20-year. How long is it? Oh, this is one of those leverage funds. I'm not sure. Anyway, this thing's been going down, down, down. Now it's turning up a little bit. Let's see what it looks like on a 5-year. Yeah. Okay. So you got a rising. Here's your neighborhood right there, $16. You don't want this thing going under $16. You'd like it to stay above there and get that red line going higher and higher and higher. Because when that happens, sometimes you get a nice run, like from 10 to 22. So if it takes out 22, there it goes, right? And this red line is rising. That's very good. The RSI is at 60. That's very good. So you got two good things going there. Let's go to the 1-year. Okay, a little bit, a little bit extended here. So again, starts breaking above 20 though. Let's go back over. Yeah, see, starts breaking above 20 and then 22. The acceleration phase could happen pretty fast on this thing. Again, it's extended with a 60 RSI on the 1-year, and on the 1 month, RSI's come back down. So it looks like it's corrected a little bit to bring the RSI down on the real short-term trading thing. So, but, again, it's natural gas. It's very much in demand. Some people are saying that I have heard on different broadcasts that next fall, which is going to be here before you know it, it's already April, right? Put 6 months on it, you're in next fall, right? So within 6 or 7 months, there could be a situation where there could be a tight supply on the gas situation, potentially. That's what people are speculating about. If that's the case, this thing has a bright future. One that I've been looking at is RRC. Might as well share something with you. And RRC is obviously been doing pretty good ever since it got above about $20. And so it goes up to 30. It could pull back here. Let's see. I don't know how long it's been around exactly. Well, it's been around for a while. So again, this thing really gave you the buy signal if you're looking at the long. That's why I like looking at longer term charts. The buy signal came in here on January 20th at $2. And then it's been riding the blue line ever since. Yeah, if it goes through there, but then closes right back above it, you're okay. And the direction of the blue line is very important. And the direction of the red line is very important. So could this thing pull back to 26 or 24? Absolutely. And at that point, it might be very interesting because then the RSI will be back towards 50. And so again, if you're bullish on this stuff, maybe you'll get lucky and get an opportunity to buy it down lower near the averages. And then if these people are correct about the natural gas for the fall, you might be able to have a nice ride ahead of you. So keep an eye on both the one you mentioned and the RRC. Okay, got Vcel. Well, this is something I've already been involved in. VALE. This is a Brazilian metals company. And as soon as it got above 30, well, I'll show you where we got interested in it. Yeah, you see here above 12. That's where we got interested. You see, they kicked it down a little bit, but look, like I told you, as long as the line's rising and you get right back above it soon, you're okay. No, even during the crash of March of 2020, the rising average on the S&P never went down. And when the market was under there for like a couple of months and then got back above it, I think it was about 2,800 on the S&P. It was really the sign that everything was going to be okay as far as the technical picture. So here again, you see another instance, you get underneath, get back above, and boom, you got another 10, 15%. So right now, let's keep this thing above 19, keep it above 18 and a half. That would be very nice. On a longer term basis, it even looks better because you see it could go up towards these highs if it can take out 24. And this is rising. So again, we wanted above 18. We wanted above 15. That's where we wanted above. And the RSI right now is still at 60. So it allows for either an acceleration. Here's the way I view RSI. Once it gets through 60, you could accelerate and it goes into the 70s, maybe even 80, or you could pull back towards 50. And as long as it holds the 50 number, it could be a good time to buy. So that gives you a little bit of an idea on Vale, I think they call it. Yeah. I'll give you a couple of sister companies to these guys as far as they seem like they're in the same deal. Cleveland Cliffs. Now, Cleveland Cliffs is having a rough time now, but you can see it had a pretty good year. I mean, it's gone from $10 up to 30. That's a 300% move. Looking at it here, right? And again, another classic example, they bring it under, but the thing never really goes down. And once they got back above 22, you got a nice $10 run. Now, this thing is very overbought technically, so that's why it could come back in. But again, it's still in a bullish configuration. So any big pullbacks towards 24 or 26 would probably be a decent time to re-enter. And again, if you look at the long-term graph on it, it's got a lot of real estate if it gets moving. So keep an eye on it. You could get a better opportunity on it, but the long-term opportunity might be quite good. So keep an eye on that one, especially if you're interested in Vale. Okay, I'm going to go around the horn a little bit and look at some of these ETFs so you get a bigger picture of what's going on out there. And then I'll wrap up with a opportunity that I can show you as well. So let's start talking first about, let's talk about interest rates. This is TLT. TLT is a proxy for 20-year bonds. And you'll see here that this thing has broken trend. But the blue has not turned down yet. So if for whatever reason we got back above here, the hike in interest rates thing that's going around would not be happening. But the red line here is pointing down, and that's not good. We're oversold, though. We're oversold, and we are getting into some support, possibly. That's why it's bouncing. Okay, another classic case is it's clearly in a downtrend. The red line's pointing straight down, but of course you're oversold, which means you could have a bounce. Okay, and that's what it's trying to do right here. And it's, right now, if you wanted to play for the bounce, there's your point of defense right there. Because again, they have already discounted a lot of Fed hiking. So don't think that if the Fed goes another quarter of a point or a half, it may have that much effect on this stuff, because you can see it's already dropped from 155 to 120 something. And that's a lot bigger than the Fed's move has been. So if they're going to go slow, catch monkey type of thing, this thing could have a bear market rally, which is what it would be. On a one-year basis, you'll see even more RSIs, very bad. But again, see how it comes back to the line? So down here under 128, boom, you got a nice $2 drop. But anyway, the interest rate market is in a downtrend, which means rates are in an uprising situation. But they've already discounted. You see 155 to 128, they've already discounted quite a bit. And that's why the market is saying, the Fed's trajectory of interest rates are so slow, and this economy is so strong because of unemployment and the balance sheets of households and of corporations, that whatever they're trying to do to stop inflation is a joke, and it's not going to affect the growth of this economy, not at this pace. Okay, so let's just see some things. Do the banks look any good? Banks are a little dodgy because of what? The inversion of the yield curve. So let's take a look and see what it looks like here. I'm going to look at some of the longer term graphs on it. It's coming back on, it looks good right here as long as it stays above 38.50 on XLF. On the 20-year graph, again, as long as it can stay above this high point here, which is what? About $38. So $38 on this thing is a big area. As long as it stays above $38, maybe it will blow out 40 and 42. Okay. And this is all the big banks, the XL, mostly bigger banks. Okay, so there you go. A couple of ones that have been fantastic. In fact, some of the stocks are making 52-week highs today, is in the utility sector. So we've been talking about this for a long time, because you see that is a nice place to be for a very long time. That's your principal going up in value, and you're getting paid a healthy dividend while you're watching your principal go up in value. Okay, let's talk about another one that has been pretty good to us, which is the SPYD. And again, if we go out 5 years on this, you'll see a very nice looking graph. This is your principal going up, up, and up, and you're getting paid a healthy dividend while you're watching your principal go up and up and up. So again, that's our idea of a good time. Get paid a healthy dividend and watch the principal rise, and maybe avoid some of the big drops, because people, if they're going to be in the market, they like to get paid a nice dividend. That's what these two things I just showed you do. And they like to see their principal rising, which obviously has also been going on. Again, when people can pay dividends, that means they have free cash flow. When they have free cash flow, that means they're making profits, right? There you go. All right, now let's take a look at some of the tech stuff. XLK is a technology ETF. And let's see what they look like. Again, they're back on the bicycle too. The key is, will they hold? So right now, I would be very much looking at XLK, and I'd want this thing to be staying above 155, 160. So there's some lines in the sand to keep an eye on there. 155, 160 on XLK. A lot of you guys are trading QQQ. Let me give you the numbers there. QQQ is at 130. See how it's running into this line right there? So it'd be very interesting to see what it does. You definitely want it staying above 351, and you definitely would like to see it holding above 370, because if it starts turning down from here, well, you see the line it's running into, and that's the blue line, which is the 36 SMA, which is a very strong line. So if we can start keeping over the 371 area, and right now it's right there. So if it goes above the 371 area, you'll be in a pretty good shape. But if it's not, this might be a place to consider what? Hedging. And I'll talk about that in a second. Okay. So there's your QQQ, and there's your tech. Now, what about semis? Everybody loves semiconductors. Well, the SMH, which is a smorgasbord of them, again, very similar. That's why I'm saying, this next 2 weeks are going to be very interesting, because again, the end of quarter window dressing is behind us at some point. The short covering obviously has been done, and the earnings that are now expected to be fantastic have been discounted to some degree, possibly. And so you may be primed, because you're running into some of these moving averages. If it can't stay above these, this would be the neighborhood where there could be vulnerability. That's where I'm coming up with that. Okay. Doesn't mean it's going to collapse by any means. In fact, all those support levels, resistance levels I talked about, could be now support if we do have a correction. Unless the Fed starts going 1% at a time, I think the market is going to be very much able to handle quarter or half point moves, particularly since they wait months in between sometimes, right? I mean, they're not even going to hike at this meeting, I don't think, in April. Maybe they do. Probably they should. But if they're not going to do it till May, that's another month of free money. Okay, so there you go with the semis. Very important area here on semis, SMH. You need it to be closing above 284. Okay, and if it starts breaking back underneath 270 and 275, then that would be putting this thing a little bit dodgy. So again, great rally, fantastic. Very fast. So sometimes fast, quick rallies are actually what they call bear market rallies. All right. And so that's why we have to be careful right now, because the put call ratio used to be way above 1. And now it's down around 0.6 or something like that. So it's totally not in a bearish position right now. Not at all. So if you were thinking the market's oversold, that horse is already out of the barn. Okay. So what else do we have now? That was semis. That was the banks. I showed you the dividend deals. Okay, let's get into the travel things real quick. Okay, I'm looking at some things like Hertz. Hertz so bad. Let's see. And here's how I'm viewing Hertz. You see, this is a great setup here, as long as we can stay above 20. we got to stay above 21 to 20, well, 21. Let's stay above 21 bucks. The longer we stay above 21 bucks, the more likely in our, my view, our view is that we will resolve this to the upside. This is a rent-a-car company, right? Okay. How about we look at Away? Away is something that gives you a one-stop shop on all types of travel. Airbnb, all kinds of stuff. Okay. Right now, it's still got resistance here coming in, but it is above the red line. So we want to stay this one above 23. Let's look at the 1 year. Okay. Starting to break out, right? And look at the red line's great. So what's my number? 23. I want it to stay above 23. And if it gets going, there's real estate above, right? So there's a one-stop shop for the travel guys. And then you have Jets, which is your one-stop shop for the planes, right? And your one-stop shop on the planes looks like it's breaking out too. Again, I want it above that red line that's rising. The red line that rising comes in at 20 bucks ballpark figure. So I want it to stay above 20, and it would be nice if it stayed above 21 too. Okay. But again, the longer it can stay up here, and if it can take out 24, it's got a lot of real estate up here that it could go back into. I don't know how long this hasn't been around too long. But again, it's got a lot of potential if it can start clearing some of these numbers. So it might be premature, but it's certainly worth a look. And if you want to get involved in travel, again, Away, you've got a hotel one called Beds, BEDZ. Because, or you can try to play pin the tail on the stock. That's not illegal. But again, if you're looking at something that has to do with hotels, this is something that has to do with the hotels. And if you're looking at something with the airline, Jets, if you're looking at a broad-based travel situation, you're looking at Away. And again, if you're looking at rent-a-car, this one I like, but then they turned into a meme stock. Now, this thing I was all over during the crash because everyone was saying, no one's ever going to rent a car again. And I said, I think they will. So as you can see here, it went down to like 15 bucks, I think, or something like that. Let's take a look. Yeah. So during the crash here in 2021, this thing went down to like 30, 50 bucks. And then it became some kind of a squeeze play and went to 550. Then it went all the way back down to 150. So, this is a rough racket. So I ditched this thing and I go with the Hertz. But obviously today it had a great day, up 4%. But I don't know what's going on here. And when I don't know, I stay away. All right. I would like to invite you guys to go to the website, optionprofessor.com, optionprofessor.com. Also, you can put your contact information in there, and I could speak to you more about the metals area, which I didn't get a chance to get into, or crypto, which is another area that people have a lot of interest in, but time has run out, so I can't do it. So again, you go to optionprofessor.com, put your information in there, and then we'll be able to speak either later today or tomorrow or sometime this week. Here's the deal. I have been doing this for decades, and I've got quite a bit of knowledge and experience in this area. So what I did is I put together PDF reports. And in the PDF report, I give you my opinion on how to hedge downside risk, but also upside surprises. And as you can see, upside surprises in the last 2 weeks can cost people a lot of money. So the bottom line is that, in fact, I have a friend who got tired of NVIDIA going down, and rather than doing a replacement on it, he just got out, and now the darn thing's up at 280 or something from 215. So there's real value in learning how to hedge downside and upside surprises. And I have a PDF report that's available. And when you go to the website, optionprofessor.com, you can put in your information and you can get that. And I'll explain how to get it when you put your information in. So again, if you have questions that we did not answer or questions you'd like to have me field, I would be more than happy to work with you on that. Again, I don't give any advice, but I do have opinions and viewpoints and information on things. So do take advantage of that. Optionprofessor.com. com. And it's the top of the hour now, so I'm going to be wrapping up. I'm sure there are other questions out there, so I can't take them all right this second. So just put your information in at the website, and we can talk either later today or sometime this week and cover these things for you. Again, I've been following these things for a long time, so I have no prejudice when the markets, look a certain way. I just call them as it is. I'm kind of like an umpire. And like right now, the markets are extremely strong, but I have to call it like it is, in that there are some points and some time and some events coming up that may temper the enthusiasm possibly. And again, that's where I think what my value is I give experienced information and a viewpoint that is not just one way all the time. All right. So anyway, this is the Option Professor. I want to thank everybody for being here today. We went over a lot of information. So again, if you have any questions, go over to the website, optionprofessor.com, and we'll talk again down the road. Thank you very much, everybody. And I'll throw it back over to David. Or if David's not there, I'll just close it up and we will talk to you next time. Thanks a lot, everybody. See you then.